Okay, let's take a look at the second part of depreciation. In this section, we are primarily going to talk about Section 179. Section 179, unlike regular depreciation that spreads the cost of that asset over the useful life, whether it does so evenly, like straight line depreciation, or it does it in an accelerated method where you get more in the beginning and less at the end, it's still spreading, depreciation is spreading that cost out. Now, Section 179, it comes from, and they have that little double S little symbol that stands for section. That means a code section in the IRS code. And there was this Section 179 where Congress wanted to give a jolt to the economy. So they thought that if they allowed you to take the whole cost as a deduction in the year that you purchased it, then more businesses would go out and buy some equipment, and that would give a jolt to the economy. And so this is what Section 179 is all about. Instead of spreading it over the useful life, you get to take it all right now. Okay? Now, it says allows immediate expensing of qualifying property. What is the qualifying property? It has to be tangible. That means I can touch it. Personal property. Remember, that was anything other than real property that's used in a business. So it has to be actual stuff that you're using, not like inventory that you're reselling, but actually that you're using that equipment. And it can be new or used equipment. Okay. For 2019, the annual maximum amount allowed is $1,020,000 worth of stuff that you can purchase and take Section 179 on. And this amount changes from year to year. So for 2020, you'll have to look and see what the amount is. Qualifying property does not include real property or any personal property related to a rental. So if you purchase a refrigerator and you stick it in the employee lunchroom in back of the store, that refrigerator is tangible personal property used in your business, and you would be able to take Section 179. If you have a rental house that you rent out to a family and you purchase a refrigerator and you put it in that house, it's now personal property related to a rental, and therefore you cannot take Section 179 on it. You will have to use regular maker's depreciation. Section 179 is limited by two things. Okay, and they have a threshold. If you put in property that's more than that threshold, which for 2019 was $2,550,000, then you have to reduce your Section 179 dollar for dollar. So if you bought $2,551,000 worth of stuff that could have Section 179 on it, so that doesn't include the real property, and it doesn't include anything related to a rental, okay? Or it doesn't include intangible, non-touchable personal property either. Okay, so you went over by $1,000. Well, then you would have to reduce your Section 179 expense by $1,000. Okay. This type of thing spending over $2.5 million on equipment doesn't happen with small and medium businesses. They don't have that kind of money to be buying that kind of equipment. And so this Section 179 is primarily made for those small and medium businesses. If you're General Motors, yeah, you're buying more than $2.5 million worth of equipment. Okay, and so in that case, you end up not being able to use Section 179 if you're General Motors. So these large businesses buy huge quantities of equipment, they're not able to use it. Okay, you cannot take Section 179 expense in excess of taxable business income in that year. So that's another limitation. So if you only made $10,000 of net income after all your deductions other than the Section 179, then that's the maximum amount of Section 179 you can take. So you can take enough Section 179 to bring your taxable income down to zero. But you can't create a loss by doing Section 179. Now, you can, let's say you have $10,000 of taxable business income and you have a piece of equipment you bought that's $11,000, okay? So you can still take the $10,000 of Section 179 this year, and the other $1,000 that you didn't get to use because it was more than your business income, you can move that and you can take that rest next year. You can carry it forward to 2020 and then take the rest of it. You can take some Section 179 and some makers on the same asset. So that would be another thing you could have done with the $11,000 asset, that you couldn't take all of the Section 179 this year. You can either wait till next year and get the rest of it, or this year you can take the $10,000 in Section 179, and then you would still have $1,000 left on that asset, and you would take regular makers on that $1,000. Okay, here we have another example. In 2019, NanoPaint Inc.'s taxable income is $1.25 million. They placed a 7-year piece of property into service costing $539,000. It was their only asset purchase in 2019. What is the total depreciation, including election to expense, which is another name for Section 179, election to expense, if they only expense $139,000? Well, first, if they were going to take $139,000 of Section 179 and they're going to take the rest as makers, okay, you would first take that $139,000. You would take your original cost of $539,000 and subtract however much you're taking under Section 179. So $539,000 minus $139,000 leaves $400,000 left. Then you would go to your makers table. This is a 7-year piece of property. You would look under the first recovery year, and that's 14.29%. So you multiply the 400,000 by the 14.29%. The same thing goes with the following years. You would do year 2, multiply by the second recovery year table in table 7, in the 7-year column, and multiply it times the 400,000. So you would not multiply it by the original cost, which is $539,000, because you've already taken the $139,000 the first year under Section 179. So all the rest of the depreciation, the $400,000 of depreciation, that's going to be spread out over the 7 years. That is only you're going to use this $400,000. And so that gives us 196,160. Now that total 196,160 includes the 139,000 of Section 179 plus the regular maker's depreciation for the first year. Now this section goes into listed property, and we have special rules exist to limit deductions on assets that lend themselves to personal use. So cars and trucks under 6,000 pounds of gross vehicle weight are considered to be used personally as well as the business. Then those are what we're talking about. Okay, computers used in the home for both personal and business, and any other kind of entertainment, recreation, amusement, which is located at home. Okay, so cars, of course, if you use the standard mileage method, you won't have to worry about this, but we're going to, talk about it anyways. Computers, if the computer is not at home, the computer sits at the store, the shop, or whatever, then the computer is 100% business use and you don't got to worry about it. Just do regular depreciation, just 5-year maker's depreciation, or you can take Section 179 on it. However, if that computer sits in your home and you do some business on it, and you do some personal stuff on it, okay, then now it is a, quote, listed property and you have to do things separately. Okay, if the asset is used less than 50% for business, or the business use falls below 50% in some subsequent year, and you're using the actual method rather than a standard mileage method on a vehicle, you must use straight line depreciation, and Section 179 is not allowed. Okay? However, if you're using the car for business, your best bet is doing standard mileage method, and then you don't have to worry about any of these rules here. Okay? If it's a computer and you were using the computer 75% for business and now it's dropped to 25% for business, now you have to use straight line depreciation. The asset is used more than 50% for business, you must use the maker's depreciation as opposed to straight line. Okay? And there's a separate section for these listed property things on page 2 of Form 4562. The IRS limits the annual depreciation expense that may be claimed on a passenger auto if you are using the actual method of calculating the auto expense rather than the standard mileage method. The maximum allowed amount is the luxury auto limits times its business percentage. So luxury auto limits were quite low, but were raised for 2018 and after. So the annual depreciation limit is $10,100 for the first year, $16,100 for each year thereafter for autos placed in service starting 2019. So let's say, let me see if I have an example here. No. Okay. So let's say you have a $30,000 vehicle and you're doing the actual method. Okay. Then you would calculate out the $30,000. It's a 5-year property. So you would go on to 7.2 and you would see the first recovery year is 20%. So you would take 30,000 times 20%, and that is 6,000. So the 6,000 is less than this limit of 10,100. And so you would be able to take all of the 6,000 the first year. Now the second year might be something where it's less than 16,100. And so let's say you calculate out the second year and it's only it's more than the 16,100. You calculate out the second year and it's 17,000. Well, this limit for the second year is 16,100. So that's the maximum that you could take. Even though you calculated out 17,000 using the tables, you would have to limit it by this. Also, up here, it tells you have to use the business percentage too. So the example I did was based on you're using that car 100% for business. So even though it can be used for personal. Now let's say you're only using it for 80% for business, and the other 20% is you driving to the grocery store and other personal uses. So you would take the $30,000 times the 20% that's on table 7.2 for the 5-year property, like we learned how to do in the previous video, and that would equal the 6,000. Then you would have to take the 6,000 times 80% business use. So that would be 4,800. So you would get 4,800, not 6,000. Also, the limit, it would also change. So the limit for the first year is 10,100. Well, you would have to multiply that times the 80% to see what the new limit would be. Same for the second year. If you also use the vehicle 80% in the second year, you would multiply 16,100 times the 80% to see what your limit is for the second year. Generally, on vehicles, you're going to get a greater deduction with the use of the standard mileage method because it has depreciation built into it and it doesn't have any limits built into that either. So you will get your full amount and there won't be any limitation, nor will you have to go through all this saving of receipts, and nor will you have to calculate all this complex stuff. Okay? You just multiply. You do have to know, in either case, you have to keep an app or a book in your vehicle and keep track of which miles are business, which miles are not business. And so once you have that number, how many miles you put in, you multiply it by the 8 cents a mile. So you don't have to have receipts for your gas and oil and all that stuff, and you're good to go. If you are filling out a Form 4562, which is the depreciation form for the IRS, and you're filling out one of those for a self-employed taxpayer, and there is this auto expense from the standard mileage method, you are going to fill out the information about the vehicle on page 2 of the 4562 and leave the back of the Schedule C blank. Now, what we did in the previous module on D2L when we were working on the self-employed module, we showed you how to put in the mileage information and car information on the back of the Schedule C. So that was assuming that you didn't have any depreciation. then you go ahead and put it on the Schedule C. If you do have depreciation and you're going to fill out a 4562 anyway, then you put the car information on page 2 of the 4562 and leave it off of the Schedule C. You're still going to put your auto expense on line 9 of the front of the Schedule C. That's your standard mileage, however much you came up with, or your actual, however much you came up with, goes on line 9 of the front of the Schedule C. But on the back where you said, oh, I had this many miles of that, and I started using my vehicle at such a date, all that stuff, you would just leave that blank and you would put it instead on page 2 of the 4562. There are lines, line 24A and B, which asks you, do you have evidence? And if so, is the evidence written? And you better say yes for both of those, or you cannot take this deduction. Okay, and then line 26, columns A, B, and C, and all of section B on the back of the 4562 is what you would fill out. And we will go through this on a separate video. We'll be going through the 4562 and we will show you then. If you're not filling out the 4562 because you don't have any depreciation to take, then you can put the auto information on the back of the Schedule C like we did in the previous module. Okay? Either way, again, the calculation of how much you're going to take for your auto expense goes on line 9 of the Schedule C. Total the depreciation, including your section 9, which would be on line 12 of the 4562, the makers on any old assets, those purchased before 2019, stuff you bought from 5 years ago, whatever, that's still being depreciated, those all get totaled up, and that total goes on line 17 of the 4562, and then any makers that you're taking on new assets goes in section B on the front of the 4562. You add all that up, the line 12, the line 17, and the line 19s in section B, and that goes to the bottom of the front page of the 4562. And you transfer that total number to line 13 on the front of the Schedule C. And line 13 says right on it, depreciation and section 179. Okay, and it says attach a form 4562. Okay, this concludes the second part. There will also be another video made to show you how to fill out a 4562.